Welcome back today with Questions A2, Recognition, Measurement, Evaluation, and Disclosure. To follow up on the previous and upcoming questions, please follow the channel and like the videos to support us in completing all the CMA certification questions. Let's get started.
Question 1. Claire Enterprises has $150,000 in accounts receivable at the end of year 1, and it estimates its bad debts to be 5% of the receivables. Hence, the accountant reports $7,500 as bad debts and the net realizable value as $142,500. Under which of the following circumstances will the amount of bad debts reported most likely reduce? A. If the company shortens the credit period allowed. B. If the company lengthens the credit period allowed. C. If the allowance for doubtful accounts has a credit balance of $1,500. D. If the allowance for doubtful accounts has a debit balance of $1,500. The answer is C. If the allowance for doubtful accounts has a credit balance of $1,500. If there is an existing credit balance in the allowance for doubtful accounts, then the bad debt expense should be adjusted downward, as it is necessary to adjust the balance only to the desired level. Therefore, the correct balance will be $7,500 minus $1,500 equals $6,000. Question 2. Drew Company produces expensive equipment for sale on installment contracts. When there is doubt about eventual collectibility, the income recognition method least likely to overstate income is A. At the time the equipment is completed. B. The installment method. C. The cost recovery method. D. At the time of delivery. The answer is C. The cost recovery method. The cost recovery is the most conservative of the methods listed in the answer alternatives. It recognizes income slower than any other method listed. This method recognizes no income until the cash collections exceed the cost of the equipment and would tend to overstate income the least. The cost recovery method is more conservative than the installment method, which recognizes profit on each dollar of cash collected. Question 3. Under IFRS, the specific identification method of accounting for inventory is required for A. All inventory items. B. Inventory items which are interchangeable. C. Inventory items that are not interchangeable and goods that are produced and segregated for specific projects. D. Biological, agricultural, inventories. The answer is C. Inventory items that are not interchangeable and goods that are produced and segregated for specific projects. The specific identification method is required for inventory items that are not interchangeable and goods that are produced and segregated for specific projects. Question 4. When would a company use the installment sales method of revenue recognition? A. When collectibility of installment accounts receivable is reasonably predictable. B. When repossessions of merchandise sold on the installment plan may result in a future gain or loss. C. When installment sales are material, and there is no reasonable basis for estimating collectibility. D. When collection expenses and bad debts on installment accounts receivable are deemed to be immaterial. The answer is C. When installment sales are material, and there is no reasonable basis for estimating collectibility. The installment method of revenue recognition is used when the realizability criterion of revenue recognition is not met. In other words, there is significant uncertainty that the receivable will be collected. Until cash is collected, realizability is therefore assured for the amount collected, no gross profit is recognized. The cost recovery method, which is even more conservative, may also be used in this situation. Question 5. On April 1, 2004, Q Company purchased new machinery for $300,000. The machinery has an estimated useful life of 5 years, and depreciation is computed by the sum of the year's digits method. The accumulated depreciation on this machinery at March 31, 2006 should be A. $192,000. B. $180,000. C. $120,000. D. $100,000. The answer is B. $180,000. $180,000, the correct answer, equals $300,000, 5 plus 4, / 5 plus 4 plus 3 plus 2 plus 1. 2 full years of depreciation have been recorded, and the SYD method uses the number of years left at the beginning of each year as the numerator of the fraction used in depreciation. At the beginning of the first and second years, 5 and 4 years of the asset's life remained, respectively. The denominator is the sum of the digits up to the asset's useful life. 5. Question 6. The latest financial statements of Darlene Properties show 140,000 outstanding shares, par value $10. The current market value per share is $25. At the beginning of current year, the company reacquired 10,000 shares at $4 per share. The company follows the cost method for the accounting of treasury stock. The current year's books of accounts show the value of outstanding shares as follows. The company's CFO did not approve the financial statements. The most likely reason for CFO's disapproval is that A. The treasury stock is incorrectly valued based on par value instead of being valued at the acquisition price. B. The treasury stock is incorrectly valued based on par value instead of being valued at the current market rate. C. The par value of the treasury stock should be presented as a deduction from par value of issued shares of the same class. D. The treasury stock should be reported as an asset. The answer is A. The treasury stock is incorrectly valued based on par value instead of being valued at the acquisition price. In the cost method, the treasury stock account is debited for the cost of the shares reacquired. Therefore, the value of treasury stocks should be $40,000, 10,000 shares times $4, valued at the acquisition price. Question 7. A company has outstanding accounts payable of $30,000 and a short-term construction loan in the amount of $100,000 at year-end. The loan was refinanced through issuance of long-term bonds after year-end but before issuance of financial statements. How should these liabilities be recorded in the balance sheet? A. Long-term liabilities of $130,000. B. Current liabilities of $130,000. C. Current liabilities of $30,000, long-term liabilities of $100,000. D. Current liabilities of $130,000, with required footnote disclosure of the refinancing of the loan. The answer is C. Current liabilities of $30,000, long-term liabilities of $100,000. The accounts payable is a current liability. The refinancing resulted in reclassifying the construction loan, which would otherwise also be current, as a non-current liability. The replacement of the loan with a non-current liability, bonds, took place before the financial statements were issued, thus meeting the requirements for refinancing on a long-term basis. Question 8. Rogers Electronics is planning to make a market in the company's stock. The company's CFO suggests the reacquisition of shares. Which of the following is most likely to happen if the CFO's suggestion is implemented? A. The risk of takeovers by competitors will increase. B. This will hinder exercise of employee stock options. C. The stock price will increase. D. This could serve as an indication of the company's negative outlook about its future performance. The answer is C. The stock price will increase. Reacquisition reduces the number of shares a company has outstanding without altering the value of the company. Therefore, the stock price of the company will increase. Question 9. Shelton Devon Corporation has 2 subsidiaries, of which 30% of ownership in each subsidiary lies with Shelton Devon. The CEO of the company is not in favor of presenting consolidated financial statements. Based on the information, which of the following is most likely true? A. The decision of the CEO is correct as companies are required to issue consolidated statements only when the ownership exceeds 50%. B. The decision of the CEO. The answer is A. The decision of the CEO is correct as companies are required to issue consolidated statements only when the ownership exceeds 50%. As required by ASC 810 Consolidation, formerly SFAS number 94, consolidation of all majority-owned subsidiaries, all companies with subsidiaries are required to issue consolidated statements including each subsidiary they control, usually meaning 50% or more ownership. Question 10. The following information was derived from the 2005 accounting records of Clem Co. Clem's 2005 cost of sales was A. $455,000 billion, $485,000 C. $507,000 D. $512,000. The answer is D. $512,000. The goods on consignment are included in Clem's inventory and therefore are included in the computation of Clem's cost of goods sold. The only costs not included in the computation are the 2 freight out costs. Freight out is a distribution expense. This cost does not contribute to the process of placing the goods into saleable condition. Only costs that assist in placing goods into saleable condition are inventoried. Because this cost is required to place those items on consignment, freight in is an inventorial cost, as is transportation to consignees. Question 11. Brass Company reported income before income tax expense of $60,000 for 2000. Brass had no permanent or temporary timing differences for tax purposes. Brass has an effective tax rate of 30% and a $40,000 net operating loss carry forward from 1999. What is the maximum income tax benefit that Brass can realize from the loss carry forward for 2000? A. $12,000. B. $18,000. C. $20,000. D. $40,000. The answer is A. $12,000. The net operating loss, NOL, carry forward of $40,000 is negative taxable income from the past that can be used to absorb future taxable income. With no temporary or permanent differences, we can assume taxable income and pre-tax accounting income are the same. The full amount of the NOL can be used to absorb $40,000 of 2000 income, saving $12,000 of tax, $40,000 x 0.30. The firm will pay only $6,000 in tax for the 2000 tax year, $60,000 to $40,000, x 0.30. The savings of $12,000 are the realization of the tax benefit recognized in previous years, when the firm recorded a deferred tax asset for the future tax benefit of the NOL. Question 12. GOW Constructors Incorporated has consistently used the percentage of completion method of recognizing income. In 2004, GOW starts work on an $18 million construction contract that is completed in 2005. The following information is taken from GOW's 2004 accounting records. What amount of gross profit should GOW have recognized in 2004 on this contract? A. $1.4 million. B. $1.2 million. C. $900,000. D. $600,000. The answer is D. $600,000. Percentage of completion for 2004 equals $5.4 million $5.4 million plus $10.8 million equals 33%. Gross profit recognized in 2004 equals 0.33, $18 million, $5.4 MN plus $10.8 MN equals $600,000. The denominator of the proportion of completion, which is estimated total project cost, includes costs to date and costs remaining. The proportion is multiplied by total estimated project profit, the difference between contract price and total estimated project cost. Question 13. Which of the following is included in other comprehensive income? A. Unrealized holding gains and losses on trading securities. B. Unrealized holding gains and losses that result from a transfer of a security from available for sale category to the trading category. C. Foreign currency translation adjustments. D. The difference between the accumulated benefit obligation and the fair value of pension plan assets. The answer is C. Foreign currency translation adjustments. Foreign currency translation adjustments are reported in other comprehensive income. Question 14. The suppliers of a company provide cash discounts at 1/10 N/40. Other suppliers offer cash discounts of 3/10 N/40. Assuming the current market borrowing rate is 15%, which of the following decisions should the company take? A. The company should not avail itself of the cash discount as the scheme represents an opportunity cost of 12.29%, which is lower than the market borrowing rate. B. The company should avail itself of the cash discount as the scheme represents an opportunity cost of 37.63%, which is higher than the market borrowing rate. C. The company should make payments in 35 days to break even with the market rate of borrowing. D. The company should not avail itself of the cash discount as the scheme represents an opportunity cost of 37.63%, which is higher than the market borrowing rate. The answer is A. The company should not avail itself of the cash discount as the scheme represents an opportunity cost of 12.29%, which is lower than the market borrowing rate. Since the opportunity cost of the discount is lower than the market rate of borrowing, the company will not benefit by availing itself the cash discount. Question 15. Calvin Software has invested in the equity stock of Biotech Corporation. Its holdings consisted of 35% of the voting stock. The CFO suggests acquiring more stock of Biotech Corporation based on the information. Which of the following will be true? A. Additional acquisitions beyond 15% will require Calvin Software to issue consolidated financial statements. B. Calvin's total value will decrease as incidental costs of acquisition must be subtracted when holdings exceed 35%. C. The circumstances leading to the decision to acquire additional shares shall be disclosed in the notes to the financial statements. D. Any additional acquisition of assets up to 20% should be classified as held to maturity. The answer is A. Additional acquisitions beyond 15% will require Calvin Software to issue consolidated financial statements. When an investor acquires an interest in the invested, the acquired percentage of voting stock determines the method of accounting. If the holdings are greater than 50%, the investor company needs to issue consolidated financial statements. Question 16. South Company purchased a machine that was installed and placed in service on January 1, 2004 at a cost of $240,000. Salvage value was estimated at $40,000. The machine is being depreciated over 10 years by the double declining balance method. For the year ended December 31, 2005, what amount should South report as depreciation expense? A. $48,000. B. $38,400. C. $32,000. D. $21,600. The answer is B. $38,400. Depreciation in 2004 equals $240,000, 2/10 equals $48,000. Depreciation in 2005 equals $240,000 to $48,000, 2/10 equals $38,400. The DDB method's rate is always twice the straight-line rate, or 2/useful life. The method does not subtract salvage value when computing depreciation, but it also does not reduce book value below salvage value. The depreciation in any year is the rate times the beginning net book value of the asset. Question 17. In which one of the following cases is an investor most likely to use the equity method to carry and report an investment in an investee? A. Investor owns 15% of the voting stock of the investee and has no other affiliation with the investee. B. Investor owns 40% of the voting stock of the investee, and the investee is in bankruptcy. C. Investor is a manufacturing firm that owns 25% of the voting stock of a consulting firm. D. Investor owns 30% of the voting stock of the investee but is unable to obtain representation on the investee's board of directors or obtain significant information from the investee. The answer is C. Investor is a manufacturing firm that owns 25% of the voting stock of a consulting firm. An investor that owns 25% of the voting stock of an investee, in the absence of evidence to the contrary, is presumed to be able to exercise significant influence over the investee. The fact that the investor and the investee are in different lines of business generally does not mitigate the influence the investor is able to exercise. Question 18. For a marketable equity securities portfolio classified as available for sale, which of the following amounts should be included in the period's net income? 1. Unrealized temporary losses during the period. 2. Realized gains during the period. 3. Changes in the valuation allowance during the period. A. 3 only. B. 2 only. C. 1 and 2. D. 1, 2, and 3. The answer is B. 2 only. On available for sale securities, only realized gains, from sale or reclassification, are recognized in the period. These securities are not sold for the purpose of relatively quick sale. Rather, they are held for different purposes and may be held long-term. The unrealized changes in market value are recorded in owner's equity. Question 19. When the FIFO inventory method is used during periods of rising prices, a perpetual inventory system results in an ending inventory cost that is A. The same as in a periodic inventory system. B. Higher than in a periodic inventory system. C. Lower than in a periodic inventory system. D. Higher or lower than in a periodic inventory system, depending on whether physical quantities have increased or decreased. The answer is A. The same as in a periodic inventory system. FIFO produces the same results for periodic and perpetual systems. FIFO always assumes the sale of the earliest goods acquired. Therefore, unlike LIFO periodic, goods can never be assumed sold before they are acquired. Cost of goods sold and ending inventory are the same under FIFO for both a periodic and a perpetual system. Question 20. GAR company factored its receivables. Control was surrendered in the transaction, which was on a without recourse basis with Ross Bank. GAR received cash as a result of this transaction, which is best described as A. Loan from Ross collateralized by GAR's accounts receivable. B. Loan from Ross to be repaid by the proceeds from GAR's accounts receivable. C. Sale of GAR's accounts receivable to Ross, with the risk of uncollectible accounts retained by GAR. D. Sale of GAR's accounts receivable to Ross, with the risk of uncollectible accounts transferred to Ross. The answer is D. Sale of GAR's accounts receivable to Ross, with the risk of uncollectible accounts transferred to Ross. When receivables are factored and control is surrendered, the transaction is treated as a sale. A transfer in which control is surrendered will not be treated as a borrowing. The risk of uncollectible accounts is not retained by the seller in a sale without recourse. Question 21. The weighted average for the year inventory cost flow method is applicable to which of the following inventory systems? Periodic perpetual. A. Yes yes. B. Yes no. C. No yes. D. No no. The answer is B. Yes no. The weighted average method computes a weighted average unit cost of inventory for the entire period and is used with periodic records. The moving average method requires that a new unit of cost be computed each time new goods are purchased and is used with perpetual records. Question 22. Under which of the following situations will a company appropriate or restrict its retained earnings? A. When the company has potentially dilutive shares outstanding. B. When the company has disclosed contingent liabilities in footnotes. C. When the dividends paid by the company are more than the industry average. D. When the fair value of one or more securities cannot be determined. The answer is B. When the company has disclosed contingent liabilities in footnotes. Reasons that a firm might appropriate or restrict retained earnings include loss contingencies, such as pending lawsuits. Legal restrictions related to Treasury stock. Contractual restrictions related to bond indentures. Plant expansion or debt retirement. Question 23. Verona Company had $500,000 in short-term liabilities at the end of the current year. Verona issued $400,000 of common stock subsequent to the end of the year, but before the financial statements were issued. The proceeds from the stock issue were intended to be used to pay the short-term debt. What amount should Verona report as a short-term liability on its balance sheet at the end of the current year? A. $0. B. $100,000. C. $400,000. D. $500,000. The answer is B. $100,000. There is no net use of current assets to liquidate the $400,000 amount of the liabilities because the stock issuance provided the necessary cash. Only the remaining $100,000 is classified as current. Question 24. On April 1, 2004, Hyde Corporation, a newly formed company, had the following stock issued and outstanding. Common stock, no par, $1 stated value, 20,000 shares originally issued for $30 per share. Preferred stock, $10 par value, 6,000 shares originally issued for $50 per share. Hyde's April 1, 2004 statement of stockholders' equity should report. Common stock, preferred stock, additional paid-in capital. A. $20,000, $60,000, $820,000. B. $20,000, $300,000, $580,000. C. $600,000, $300,000, $0. D. $600,000, $60,000, $240,000. The answer is A. $20,000, $60,000, $820,000. Common stock, 20,000, $1 equals $20,000. Only par value is credited to common stock. Preferred stock, 6,000, $10 equals $60,000. Only par value is credited to preferred stock. Additional paid-in capital, the amount received on issuance in excess of par common, 20,000, 30 to $1 equals $580,000 preferred, 6,000, 50 to $10 equals $240,000. Total $820,000. Question 25. Which of the following differences would result in future taxable amounts? A. Expenses or losses that are deductible after they are recognized in financial income. B. Revenues or gains that are taxable before they are recognized in financial income. C. Expenses or losses that are deductible before they are recognized in financial income. D. Revenues or gains that are recognized in financial income but are never included in taxable income. The answer is C. Expenses or losses that are deductible before they are recognized in financial income. Expenses or losses that are deductible before they are recognized in financial income would result in future taxable amounts. For example, the cost of an asset may have been deducted for tax purposes faster than it was depreciated for financial reporting. In future years, tax depreciation will be less than financial accounting depreciation, meaning future taxable income will exceed future financial accounting income. Question 26. If ending inventory for 20 times 5 is understated because certain items were missed in the count, then A. Net income for 20 by 5 will be overstated. B. CGS for 20 by 5 will be understated. C. Net income for 20 by 5 will be understated, but net income for 20 by 6 will be unaffected. D. Net income for 20 by 5 will be understated and CGS for 20 by 6 will be understated. The answer is D. Net income for 20 by 5 will be understated and CGS for 20 by 6 will be understated. Use the equation BI plus PUR equals EI-CGS. When EI is understated, CGS must be overstated to maintain the equation. Net income, therefore, is understated, 20 by 5. Then next year, BI is also understated because BI for 20 times 6 is EI for 20 by 5. Using the equation, if BI is understated, CGS is also understated to maintain the equation. Question 27. Larkin Company has owned 25% of the common stock of Devon Company for a number of years, and has the ability to exercise significant influence over Devon. The following information relates to Larkin's investment in Devon during the most recent year. Carrying amount of Larkin's investment in Devon at the beginning of the year $200,000. Net income of Devon for the year $600,000. Total dividends paid to Devon stockholders during the year $400,000. What is the carrying amount of Larkin's investment in Devon at year-end? A. $100,000 billion, $200,000 C. $250,000 D. $350,000. The answer is C. $250,000. Larkin's investment in Devon at year-end would be computed as the carrying amount of the investment at the beginning of the year, $200,000, plus Larkin's share of Devon's reported net income for the year, $600,000 x 0.25 equals $150,000, Larkin's share of Devon's dividends paid during the year. $400,000 x 0.25 equals $100,000, or $200,000 plus $150,000 equals $350,000 to $100,000 equals $250,000. The correct answer. Question 28. Elsa Fashions wants to eliminate its credit department. It also wants to get cash immediately and continue all operational activities directly with the customers. Which of the following approaches would be the best to fulfill the company's objectives? A. Factoring. B. Securitization. C. Sale with recourse. D. Special investment vehicle. The answer is A. Factoring. Companies that use factoring get immediate cash and can eliminate their credit department, because factors usually take over these tasks. The company continues all operational activities directly with the customers, such as order placement and fulfillment. Question 29. Caleb Corporation has 3 financial statement elements for which the December 31st, year 1 book value is different than the December 31st, year 1 tax basis. As a result of these differences, future taxable amounts are A. $50,000, B. $80,000, C. $155,000, D. $205,000. The answer is B. $80,000. The officer insurance policy difference, $75,000, is a permanent difference which does not result in future taxable or deductible amounts. The warranty difference, $50,000, is a temporary difference, but it results in future deductible amounts in future years when tax warranty expense exceeds book warranty expense. However, the equipment difference, $80,000, is a temporary difference that results in future taxable amounts in future years when tax depreciation is less than book depreciation. Question 30. Which of the following conditions must exist in order for an impairment loss to be recognized? 1. The carrying amount of the long-lived asset is less than its fair value. 2. The carrying amount of the long-lived asset is not recoverable. A. I only. B. 2 only. C. Both 1 and 2. D. Neither I nor 2. The answer is B. 2 only. The test for impairment for an asset in use is whether the carrying value, book value, is less than its recoverable cost. An asset's recoverable cost is the sum of its estimated net cash inflows projected for its remaining life. When book value recoverable cost, the carrying value is not recoverable. In other words, the asset is booked at more than the sum of its future net cash inflows. For example, if an asset's carrying value is $100 and its recoverable cost is $80, then its carrying value is not recoverable, only $80 is recoverable. The amount of the loss recognized is the difference between carrying value and fair value, but that difference is not used for testing whether an asset is impaired. Question 31. The management accountant of Till Board Inc. has recognized a sale of receivables or factoring in the books for the current year. In doing so, he considered these 3 factors. 1. Ability of the buyer to sell the asset. 2. Surrender of control. 3. Asset outside the reach of the seller. Under which of the following situations can the decision of the management accountant go wrong? A. The seller should be able to use the asset as collateral. B. The asset is outside the reach of the creditors of the company. C. The company has an agreement to repurchase the asset before its maturity. D. The seller is liable for any loss realized or gain earned on the asset. The answer is C. The company has an agreement to repurchase the asset before its maturity. To be a sale, the transferor must surrender control over the transferred assets. An agreement to repurchase the assets is prohibited for the surrender of control condition to be met. Question 32. The calculation of the income recognized in the third year of a 5-year construction contract accounted for using the percentage of completion method includes the ratio of A. Costs incurred in year 3 to total billings. B. Costs incurred in year 3 to total estimated costs. C. Total costs incurred to date to total billings. D. Total costs incurred to date to total estimated costs. The answer is D. Total costs incurred to date to total estimated costs. The proportion of completion at the end of any year for a construction contract is the amount of work done, divided by the total amount of work required for the contract. Typically, cost is the measure of work done. At the end of year 3, the numerator is the cost incurred for all 3 years. The denominator is the total estimated cost of the project, which is the sum of 1. The cost incurred for all 3 years so far, plus 2. Estimated costs to complete as of the end of year 3. The percentage of completion changes each year, because both the numerator and denominator change. The gross profit to be reported for year 3 is the profit for all 3 years, using the proportion of completion just computed, less the profit already reported in the first 2 years. Question 33. Which of the following methods of accounting for inventory is not allowed under IFRS? A. LIFO. B. Specific identification. C. FIFO. D. Weighted average. The answer is A. LIFO. The LIFO method is not allowed under IFRS. All of the other methods are allowed. Question 34. Peel Company received a cash dividend from a common stock investment. Should Peel report an increase in the investment account if it accounts for the investment as held for trading or uses the equity method of accounting? Held for trading equity method. A. No. B. Yes. C. Yes no. D. No yes. The answer is A. No. A dividend never increases the investment account under any accounting method. Under the cost method, the dividend is recorded as revenue. Under the equity method, the dividend is recorded as a decrease in the investment account. Question 35. Lee Incorporated acquired 30% of Polk Corp's voting stock on January 1, 2004 for $100,000. During 2004, Polk earned $40,000 and paid dividends of $25,000. Lee's 30% interest in Polk gives Lee the ability to exercise significant influence over Polk's operating and financial policies. During 2005, Polk earned $50,000 and paid dividends of $15,000 on April 1 and $15,000 on October 1. On July 1, 2005, Lee sold half of its stock in Polk for $66,000 cash. Before income taxes, what amount should Lee include in its 2004 income statement as a result of the investment? A. $40,000 billion, $25,000 C. $12,000 D. $7,500. The answer is C. $12,000. $12,000 equals 0.30, $40,000. Under the equity method, the investor recognizes its share of investee earnings in its own income. The equity method is used because Lee has significant influence over Polk. Question 36. A shoe retailer allows customers to return shoes within 90 days of purchase. The company estimates that 5% of sales will be returned within the 90-day period. During the month, the company has sales of $200,000 and returns of sales made in prior months of $5,000. What amount should the company record as net sales revenue for new sales made during the month? A. $185,000. B. $190,000. C. $195,000. D. $200,000. The answer is B. $190,000. The effective estimated returns is recognized in the month of sale. Net sales to be reported for the current month equal $200,000 less the returns expected on those sales, 5% or $10,000, or $190,000. The actual returns granted in the current month on previous month's sales were recognized as reductions in net sales in those previous months. Question 37. When accounting for income taxes, a temporary difference occurs in which of the following scenarios? A. An item is included in the calculation of net income, but is neither taxable nor deductible. B. An item is included in the calculation of net income in one year and in taxable income in a different year. C. An item is no longer taxable, owing to a change in the tax law. D. The accrual method of accounting is used. The answer is B. An item is included in the calculation of net income in one year and in taxable income in a different year. This answer describes one category of temporary difference. In general, a temporary difference is one for which the item's recognition takes place at a different rate or time for financial reporting and the tax return. However, the total impact of the item is the same over its life, for both systems of reporting. Question 38. Temporary differences arise when revenues are taxable. The answer is A. Yes. Examples of temporary differences are revenues which are taxable both before and after they are recognized in financial income. Note that emphasis is placed on the difference between book and tax, not the chronological order of the reporting. Question 39. On January 2, Year 1, Sarah Company purchased 20% of Lex Corporation's common stock for $150,000. Sarah Corporation intends to hold the stock indefinitely. This investment did not give Sarah the ability to exercise significant influence over Lex. During Year 1, Lex reported net income of $175,000 and paid cash dividends of $100,000 on its common stock. There was no change in the fair value of the common stock during the year. The balance in Sarah's investment in Lex Corporation account at December 31, Year 1 should be A. $130,000. B. $150,000. C. $165,000. D. $185,000. The answer is B. $150,000. The equity method is to be used when the investor owns 20% or more of the investee's voting stock, unless there is evidence that the investor does not have the ability to exercise significant influence over the investee. Since this is the case, Sarah must carry the stock at fair value in the available for sale category. Under this method, dividends received are to be recognized as income to the investor, and the investment account is unaffected. Also, under this method, the investor's share of the investee's net income is not recognized. Any changes in the fair value of the stock would be reflected in the book value of the stock with a corresponding amount in a separate account in stockholders' equity. As there has been no change in the fair value, the investment account would still have a balance of $150,000 at 12/31/Y1. Note that the dividends received by Sarah were distributed from Lex's net accumulated earnings since the date of acquisition by Sarah. However, if dividends received had been in excess of earnings subsequent to the investment date, they are considered a return of capital and would be recorded as a reduction in the investment account. Question 40. Willam Company reported the following liabilities at December 31, 2001. Accounts payable trade $750,000. Short-term borrowings $400,000. Mortgage payable, current portion $100,000 $3,500,000. Other bank loan, matures June 30, 2002 $1 million. The $1 million bank loan was refinanced with a 20-year loan on January 15, 2002, with the first principal payment due January 15, 2003. Willem's audited financial statements were issued February 28, 2002. What amount should Willem report as current liabilities at December 31, 2001? A. $850,000 billion, $1,150,000. C. $1,250,000. D. $2,250,000. The answer is C. $1,250,000. The $1 million loan was successfully refinanced on a long-term basis and therefore was moved to the non-current liability category. The refinancing took place before the financial statements were issued, thus meeting the requirements for reclassification on a long-term basis. The remaining items are all current: $750,000 accounts payable plus $400,000 short-term borrowings plus $100,000 current portion of mortgage payable equals $1,250,000 total current liabilities. Question 41. Bowman Devices values its inventory using last in, first out, LIFO method. For the current year, the inventory usage exceeded the purchases. Assuming the prices are falling, how will this situation affect net income for the year? A. Net income will be lower due to higher LIFO liquidation. B. Net income will be lower due to lower LIFO liquidation. C. Net income will be higher due to lower LIFO liquidation. D. Net income will be higher due to higher LIFO liquidation. The answer is B. Net income will be lower due to lower LIFO liquidation. If usage of goods exceeds purchases during a period, a situation called LIFO liquidation can occur. If prices are falling, LIFO liquidation results in lower income levels being reported and likely lower taxes as well. Question 42. During the year, Hauser Company wrote off a customer's account receivable. Hauser used the allowance method for uncollectible accounts. What impact would the write-off have on net income and total assets? Net income total assets. A. Decrease. B. Decrease no effect. C. No effect decrease. D. No effect. The answer is D. No effect. Under the allowance method for uncollectible accounts, there is no impact on the balance sheet or net income when the receivable is written off. The estimated uncollectible is recognized at the time of the sale, therefore, when the account is written off, the allowance and the accounts receivable are both reduced, resulting in no effect on the income statement or balance sheet. Question 43. Goodwill should be tested for value impairment at which of the following levels? A. Each identifiable long-term asset. B. Each reporting unit. C. Each acquisition unit. D. The entire business as a whole. The answer is B. Each reporting unit. Goodwill is included in an asset group when the group is a reporting unit. A reporting unit is an operating segment or one level below. Question 44. When the equity method is used to account for investments in common stock, which one of the following affects the investor's reported investment income? A change in market value of investee's common stock, cash dividends from investee. A. Yes. B. Yes and no. C. No yes. D. No. The answer is D. No. Under the equity method of accounting, changes in the market value of the investee's common stock are ignored. Further, cash dividends received by the investor from the investee are not recognized as investment income, rather they are recognized as a debit to cash and a reduction in credit to the investor's investment in investee account.